Good afternoon to all of you. I hope I'm audible for everyone. First of all, let me extend a very warm welcome to all of you who are joining with us for the webinar organized by Central Bank Studies to discuss the state of Sri Lankan economy, challenges and outlook as reflected in the annual report 2021. Central Bank Studies regularly conducts various public events, including expert panel discussions, high-level seminars, and public lectures. Now, this particular public lecture of Central Bank Annual Report is one of such events with a very high level of public interest, proving that we have a quite good number of participants here today, and we believe your interest will definitely be served. And I must mention that Economic Research Department of Central Bank is collaborating with us in delivering this lecture. Having said that, to take this event forward and moderate it, I'd now like to invite Dr. Kitsiri Ahalepola, Additional Director of Economic Research Department of Central Bank, to move forward. Dr. Ahalepola, the screen is yours, sir.
Thank you very much, Kushan. Very good afternoon to you all. We warmly welcome you to the Central Bank's webinar on the state of economy, challenges, and outlook, as reflected in the Central Bank Annual Report 2021. At the outset, let me first share with you the structure of the webinar today. First, the Deputy Governor, Mrs. Yvette Fernando, will deliver the opening remarks, followed by the presentation on the state of economy, challenges, and outlook, as reflected in the Central Bank Annual Report 2021. The presentation will be delivered by the Director of Economic Research, Dr. K G Harishchandra, and it will take an hour, hopefully. Then the floor will be open for questions and answers session, Q&A session, and it will last for about 30 minutes. Please note that we will take typed in questions only through Q&A option in Zoom, or alternatively, you can reach us through the Facebook page of the Central Bank. So please note that we wouldn't be able to accept voice questions in the interest of time. We also appreciate if you could submit your questions briefly, allowing us to accommodate as many questions as possible. You can pose your questions during the conduct of the presentation without waiting till it ends. So your questions will be responded by our distinguished panel today, chaired by Deputy Governor Mrs. Yvette Fernando and Assistant Governor Mr. Rohan Vijayasekara, Assistant Governor Mr. R.A. Jayala, Director of Economic Research, Dr. K G Harishchandra, and Additional Director of Economic Research, Dr. Sujitha Jagajeevan. With that information on the format of this webinar today, let me kindly invite Deputy Governor Ms. Yvette Fernando for her opening remarks. Over to you, Madam. Thank you.
Good afternoon, ladies and gentlemen. On behalf of the Central Bank of Sri Lanka, I am pleased to welcome you to this webinar on the state of the economy, challenges and outlook as reflected in the Central Bank Annual Report 2021. For the third consecutive year, the Center for Banking Studies of the Central Bank is arranging this in virtual format. In 2021, COVID-19 had been a significant hindrance, and the current circumstances have led us to resort to this medium for this year too. This year, the Central Bank of Sri Lanka released the 72nd annual report amid significant challenges. While the year 2021 had been a relatively positive year with the economy rebounding from the railing effects of COVID-19 and the seeming return to normalcy, 2022 brought on a new set of challenges that were continuously evolving throughout the period of preparation of this publication. Accordingly, as the Director of Economic Research will explain, the staff of the Central Bank of Sri Lanka has persevered to brief the users of this report on the economic developments of the last year, while also highlighting the obvious risks that were identified as at the time of this publication. As in every year, the Central Bank Annual Report was handed over to the Minister of Finance in compliance with the statutory deadline of end April, and it was subsequently tabled in Parliament. Further, This webinar today will facilitate our continued engagement with the public on the economic developments and future direction of the economy. On that note, let me again appreciate your participation today at this webinar, despite all the practical difficulties, and look forward to a productive session. Over to you, Dr. Helpul.
Thank you very much, Deputy Governor Mrs. Yvette Fernando, for your interesting opening remarks. And now the presentation. The presentation will be delivered by the Director of Economic Research, Dr. K G Harishchandra. Dr. Harishchandra works as the Director of Economic Research, and he is a member of the Monetary Policy Committee of the Central Bank of Sri Lanka. Prior to that, Dr. Harishchandra worked in the capacity of an additional Director of Economic Research, overseeing work relating to areas of money and banking, modeling and forecasting, international trade and finance, and public finance. Previously, he has also worked as an additional Director General of the Fiscal Policy Department of the Ministry of Finance on secondment basis from the Central Bank. Dr. Harishchandra works as Chair of the Research Advisory Committee of the Economic Research Department and as the Chief Editor of Staff Studies Journal of the Central Bank. He has published research articles in international and local journals on the areas of monetary policy, inflation persistence, exchange rate regimes, business cycles, financial system stability indicators, etc. And he has authored articles for local periodicals on various themes. Dr. Harishchandra obtained his PhD and MSc in economics from the University of Manchester in the United Kingdom. He has also an MBA. He has also obtained MBA from the University of Colombo and BCom Special First Class degree from the University of Kelaniya. With that brief note, I kindly invite Director of Economic Research, Dr. K G Harishchandra, to deliver the presentation. Please. Thank you.
Thank you very much, Dr. Alapola, for that kind introduction. Let me share my slideshow to begin the presentation. Thank you very much, and very good afternoon to you all. So this is the 72nd annual report of the Monetary Board of the Central Bank for the year 2021. The preparation and publication of the Central Bank annual report is a statutory requirement as per the Section 35 of the Monetary Law Act, which stipulates that a report on the condition of the Central Bank and a review of the policies and measures adopted by the Monetary Board during the financial year, and an analysis of the economic and financial conditions which prompted those policies and measures is published within 4 months after the end of each financial year and submit it to the Minister of Finance. As you know already, the annual report is published in 2 volumes. The volume 1 contains the analysis on the state of the economy, its performance, policies and issues, together with an outlook and statistical appendices containing several data tables. The volume 2 comprises accounts and operations of the Central Bank, administrative measures adopted by the government and the Monetary Board during the year, and major legislative enactments of 2021 relating to the functions and operations of the Central Bank and banking institutions in the country. So today's presentation is basically based on the sort of volume 1, mainly the part 1 of the annual report, which consists of 8 chapters covering the main areas of the Sri Lankan economy, including some analysis on the outlook, and also some box articles on selected topics, discussion on economic issues and challenges, and policy measures as well. So before I begin the presentation to talk about the developments that have happened last year, let me begin with the current state of the economy. As you all know, the Sri Lankan economy is currently undergoing a distressed situation in a level we have never experienced before. As you know, the official reserves are at a critically low level. The servicing of external debt has been halted for the first time in the history, and debt payments are currently at a standstill, pending debt restructuring agreements with the lenders. The single-digit inflation that we have maintained for more than 12 years has been breached, and inflation now has accelerated to very high levels. Exchange rate has overshot since allowing more flexibility in its determination in March this year. The fiscal space remains extremely low despite the dire necessity of substantial fiscal consolidation. The power crisis is hindering economic activity throughout the country. And all these have led to socio-political unrest and subsequently some violence, which has been now contained to a large extent. The Central Bank Annual Report 2021 was published against this backdrop, and it contains some discussion on these economic challenges that have highlighted in early 2022. However, a bulk of this report is focused on the economic performance in last year as per the statutory requirement. So if I begin with the chapter 1 of the annual report, which provides an overall analysis of the economy during last year, the sectoral developments, major policies undertaken by the central bank in maintaining economic and price stability and financial system stability, outlook, and a discussion on several key issues and challenges affecting the economy and policies required to address the near-term and medium-term challenges that we will face. Let me first give you a snapshot of the Sri Lankan economic performance during last year and some updates in the year during this year so far. The Sri Lankan economy rebounded last year after suffering a contraction in the year before as a result of the COVID-19 pandemic. Real GDP growth was recorded at 3.7% last year, compared to the contraction of 3.6% in 2020. Unemployment rate declined to 5.1% from 5.5%, although the labor force participation rate declined to 49.9% during last year from 50.6% during the year before. Inflation increased significantly, contributed by both the supply side and demand side factors. External sector continued to face unprecedented challenges. Trade deficit widened to US dollars 8.1 billion in last year from 6 billion the year before. And the current account deficit widened to US dollars 3.3 billion in last year from 1.2 billion in the year before. Gross official reserves declined to US dollars 3.1 billion by end of last year from $5.7 billion by end of 2020. The reserve level has further deteriorated by end of April to about US dollars 1.8 billion amidst increased vulnerabilities in the external sector. The exchange rate determination was allowed more flexibility from March onwards, and since then it has depreciated significantly until the central bank introduced an arrangement to announce a variation margin of the spot exchange rate from 13 May onwards. In the fiscal sector, the performance has deteriorated significantly. Overall, fiscal balance expanded to 12.2% of GDP during last year, while current account deficit and primary balance deficit were recorded at significantly high levels of 7.7% and 6% of GDP respectively. Central government debt as a percent of GDP remained over 100% for the second consecutive year, recording at 104.6% of GDP by end of last year. which is a considerable expansion from 86.9% of GDP recorded in 2019. The extremely weak fiscal performance was a key consideration in multiple sovereign rating downgrades that took place during the year. With regard to monetary policy, the central bank changed the monetary policy stance from accommodative to tightening in August last year. The buildup of inflationary pressures, emergence of external sector imbalances, together with the notable expansion of money and credit aggregates, warranted the tightening of monetary policy. Accordingly, the policy rates have increased by 9 percentage points, and the statutory reserve ratio increased by 2 percentage points since August 2021 until thus far in 2022. As a result, the market interest rates, which declined to historically low levels amidst the pandemic, have gradually adjusted upwards. Credit to the public sector by the banking system continued to remain elevated during last year as well, while credit to the private sector also expanded. However, driven by substantially large negative net foreign assets position of the banking system, broad money growth moderated to 13.2% by end of last year. So against this backdrop, well-coordinated macroeconomic policies are needed to come out of the current economic crisis. In particular, in the real sector, a macroeconomic stabilization package is needed to put the growth trajectory back on track while strengthening and improving the efficiency of social safety net schemes. With regard to the external sector, the key considerations include seeking an economic adjustment program with the IMF, for which technical level discussions are ongoing at present. External debt restructuring, and this process is expected to commence soon. We need to seek bridging finance from bilateral and multilateral lenders. We need to ensure the exchange rate remains flexible, but without excessive volatility. And also we need to improve on non-debt creating foreign exchange inflows. In the fiscal sector, fiscal consolidation is essential through revenue enhancement measures and expenditure rationalization and prioritization. Achieving public debt sustainability has become the major prerequisite to unlock the financing options for the country. Structural reforms in state-owned business enterprises to strengthen their balance sheets remain the key strategic requirement to ease pressures on the government. Meanwhile, the main policy directions of the monetary and financial sector comprise appropriate monetary policy measures to restore price stability, a gradual reduction of monetary financing, strengthening the central bank's balance sheet, and the maintenance of financial system stability. So with that, let me focus on the chapters 2, 3, and 4 of the annual report, which cover the national output, expenditure and income, economic and social infrastructure, and prices and wages. So as I just mentioned, the Sri Lankan economy rebounded by 3.7% last year, recovering from the COVID-19 pandemic-induced fallback of a contraction of 3.6% in the year before, amidst renewed threats from new variants of the pandemic. All three major economic sectors, namely agriculture, industry, and services, expanded during last year by 2%, 5.3%, and 3% respectively. With regard to gross value addition, the services sector, which is the largest sector of the economy, contributed 64%, followed by industry 28%, and agriculture sector 7.6%. Investment and consumption expenditure grew in last year, while net external demand weakened amidst rising import expenditure. Gross capital formation expanded by 23.2% in 2021 compared to the contraction of 4.2% in the year before. However, the net external demand for goods and services contracted by 31.6%, reflecting the higher growth of import of goods and services than the export of goods and services. Consumption expenditure, which comprises the largest proportion of GDP in terms of expenditure approach, recorded a significant growth of 9.9% in last year, compared to the growth of 2% in the year before. Meanwhile, domestic savings as a percentage of GDP increased to 20.1% in last year, compared to 18.7% in the year before. The national savings investment gap widened to 3.9% of GDP in 2021 from 1.6% of GDP in the year before, due to the comparatively lower growth of national savings than the growth of investment. The performance of key state-owned business enterprises in the energy sector continued to remain disconcerting, as highlighted over many years in our reports. The continuous escalation of global crude oil prices warranted the government to increase the domestic retail prices of key petroleum products in last year, after a hiatus of over 1.5 years. Electricity demand continued to expand in line with the recovery in economic activity in last year. The reliance on low-cost hydropower generation increased during the year, while the share of expensive fuel oil-based generation remained low. High share of hydropower generation has helped buoy the CEB's financial performance during last year. However, this was insufficient to offset the losses incurred during the year, as well as those losses that came from the past years. The overall performance of the port activities rebounded sharply in 2021, with operations exceeding pre-pandemic levels. Increased activity was observed in cargo handling, container handling, as well as in transshipment activity. Major infrastructure development initiatives of the Colombo port continued, including the commencement of construction of the second phase of the East Container Terminal. The Colombo port continued to be ranked high on international ranking, with the 17th position in both the Container Port Performance Index and the Port Liner Shipping Connectivity Index. The health sector performed an exceptional task supporting the country to overcome the challenge of the COVID-19 pandemic. Accordingly, by May 2022, 97% of the population over 12 years of age had obtained at least one dose of the COVID-19 vaccine, while 82% of the population over 12 years of age had obtained 2 doses, and 55% of the fully vaccinated population had obtained the COVID booster jab as well. Meanwhile, the education sector adopted the new normal of online education system to continue educational activities despite challenges faced by many. Intermittent closures of schools warranted the adoption of various novel methods to conduct education activities to overcome the challenges of the COVID-19 pandemic. Progress in poverty alleviation is likely to have been affected by the pandemic, along with the widening of already prevalent inequalities. The government initiated several social protection measures targeting vulnerable groups of the population, while continuing all existing safety net programs, despite constrained by very limited fiscal space. The government provided an allowance of rupees 5,000 per vulnerable household in 2 rounds, totaling rupees 22.3 billion last year. and an allowance of rupees 2,000 per household was provided, targeting groups that are not covered under any government assistance programs, totaling rupees 11.8 billion during the last year. The general price levels recorded an increasing trend with a notable rise towards the latter part of the year and in 2022 thus far. Global commodity price hikes of both food and non-food items, higher freight charges, domestic supply side bottlenecks, direct and indirect impacts from various price revisions and demand pressures instigated with successful control of the COVID-19 pandemic made a considerable impact on domestic prices. Prices of food items increased continuously during the last year. Prices of items in the non-food category also increased during the period with the higher pace towards the end of the year. The real wages of the employees in the formal and informal private sectors showed an increase, while the real wages of the public sector employees showed an erosion in 2021 compared to the previous year. The informal private sector wage rate index had recorded year-on-year growth of 17% by end of last year. Due to high inflation level, real wages have increased only by 2% during the year. Meanwhile, real wages of the formal private sector recorded a 64.3% increase, while public sector employees experienced a real wage erosion of 6.4% during the last year compared to the year before. With regard to the labor market performance, the labor market indicators improved during last year compared to the year before, yet the labor market has not reached the pre-pandemic levels. The labor force increased to 8.55 million in 2021 from 8.47 million recorded in the year before. The labor force participation rate decreased to 49.9% in the last year from 50.6% in the year before, with a notable gap between male and female labor force participation rates. Meanwhile, the employed population increased to 8.11 million in last year from 7.99 million in the year before, while departures for foreign employment also gathered pace in the last year. The unemployment rate declined to 5.1% during the last year from 5.5% recorded in the year before. So with that, let me move on to chapter 5, which contains the analysis on external sector developments and policies. The external current account deficit widened significantly in 2021, mainly reflecting the expansion in the trade deficit and the reduction in workers' remittances. The merchandise trade deficit increased to US dollars 8.1 billion during the last year, compared to US dollars 6 billion in the year before. Meanwhile, the surplus in trading services improved, mainly due to inflows relating to IT and BPO services and transport services, despite the moderation of tourism earnings over 2020. The deficit in the primary income account declined in 2021. As a result, the current account deficit widened to US dollars 3.3 billion during the last year. Major inflows to the financial account included the foreign currency term financing facilities of US dollars 810 million from China Development Bank, SDR allocation of around 787 US dollars million from the IMF in August 2021, and inflows on account of FDIs, including loans of US dollars 784 million. Major outflows included the outflows of foreign investment from the rupee-denominated government securities and the settlement of the maturing international sovereign bond of US $1 billion in July 2021. The trade deficit expanded due to the significant increase in imports, which outpaced the growth of exports. Earnings from exports improved by 24.4% year-on-year to a record high of US $12.5 billion. This was mainly contributed by increases in textiles and garments and rubber products. Meanwhile, expenditure of imports increased by 28.5% year-on-year to US $20.6 billion, thereby increasing the trade deficit substantially. The main contributors for this expansion of the trade deficit included the high commodity prices, normalization of economic activity, large expenditure on pharmaceutical items, including vaccines for COVID-19, and the relaxation of some of the import restrictions. Meanwhile, gross official reserves declined significantly amidst foreign debt service payments and limited foreign exchange inflows to the government. Official reserves declined to US $3.1 billion by end of 2021, compared to US $5.7 billion by end of 2020. This reflects the impact of foreign currency debt service payments and limited foreign exchange inflows to service the maturing government debt service obligations. This level of reserves was sufficient to finance about 1.8 months of imports. Meanwhile, gross official reserves have declined further and remain at critically low levels of 1.8 billion by end of April this year. This level of reserves includes the swap facility from the People's Bank of China, which is subject to the conditionalities of usability, thus making the level of liquid reserves at a critically low level. The overall balance in the balance of payments was recorded a deficit of over 3 billion during the last year. Meanwhile, Sri Lanka's total external debt rose in 2021 to US $50.7 billion, which is about 60% of GDP. External debt service payments incurred during the year amounted to US $4.5 billion. Major reasons for the increase in external debt positions were the receipt of 2 foreign currency term financing facilities obtained from the China Development Bank, engage with new bilateral currency swap arrangements with the Bangladesh Bank and the People's Bank of China, increase in intercompany borrowings of direct investment enterprises, as a number of direct investment enterprises received intercompany loans and shareholder advances during the year, increase in the outstanding external debt of deposit-taking corporations, owing to the significant increase in currency and deposits. With regard to exchange rate developments, although the exchange rate was maintained at a certain level during 2021 and also in early 2022, considering the emerging difficulties on the external front, the central bank allowed measured adjustment in the exchange rate since early March 2022. Consequently, the exchange rate has depreciated substantially by market forces. However, the central bank initiated an arrangement to pre-announce a variation margin of the interbank spot exchange rate so as to minimize any excessive volatility of the exchange rate that would help speed up the correction from the initial overshooting that took place in March 2022. The real effective exchange rate indices remain below the base year level in 2021, indicating competitiveness of the Sri Lanka rupee. In order to address the current external sector issues and to complement them with broad economic reforms aimed at resolving persistent and long-standing issues in the economy. The government and the central bank took further measures in early 2022, including the initiation of engagements with the IMF and the announcement of the external debt servicing standstill as an interim measure until the debt restructuring plan is worked out. So with that, let me turn to the chapter 6, which has a discussion on fiscal policy and government finance. As we know, the budgetary operations of the central government weakened in 2021, reflecting the impact of deep-rooted imbalances and unintended consequences of certain fiscal policy measures. The mobilization of government revenue as a percent of GDP weakened to a historic low in 2021, mainly due to the continuation of the low tax regime that was introduced during the latter part of 2019. Accordingly, total revenue declined to 8.7% of GDP during 2021, compared to 9.1% of GDP in the year before. These revenue figures are some of the lowest in global comparison, highlighting a major structural weakness of the Sri Lankan economy. Meanwhile, government expenditure remained high during the last year, owing to higher expenditure on account of salaries and wages and interest payments, along with the pandemic-related outlays. Total expenditure and net lending increased significantly by rupees 481 billion to 3.5 trillion rupees in 2021, compared to about 3 trillion rupees in 2020. Both recurrent and capital expenditure contributed to this increase. As a percent of GDP, recurrent expenditure moderated to 16.3% in 2021 from 17% in 2020, while capital expenditure and net lending increased to 4.6% of GDP in 2021 over 3.3% registered in 2020 after the restatement of arrears payments. With regard to the fiscal balances, all fiscal balances weakened in 2021 as reflected in the expansion of the budget deficit to 12.2% of GDP from 11.1% of GDP in 2020. The current account deficit remained high at 7.7% of GDP, and the primary balance recorded a deficit of 6% of GDP compared to 4.6% of GDP in 2020. This warrants a large fiscal adjustment in terms of revenue mobilization and expenditure rationalization to strengthen fiscal consolidation and debt sustainability in the period ahead. In financing the budget deficit, government relied on the domestic banking sources as access to foreign financing remained restricted. Government relied mostly on the banking sector, specifically the central bank, in deficit financing, adding more to inflationary pressures. With regard to the outstanding external debt position, the central government debt outstanding balance increased to a disconcerting level at the end of 2021, recording at 105% of GDP compared to 101% of GDP recorded at end of 2020. As a result, the total debt service payments increased by 22.4% in nominal terms to rupees 2.4 trillion in 2021, far above the total government revenue during the year. Against this backdrop, urgent measures are needed to strengthen fiscal consolidation through timely and adequate revenue measures, while curtailing expenditure wherever possible, and as already announced by the government. The ongoing debt restructuring measures would help plan out the debt sustainability path over the medium term, With the recent announcements of revenue measures and expenditure rationalization measures, we hope there will be improvements in the fiscal from the fiscal side, which will help sort of consolidate the government debt path in the period ahead. So with that, let me move on to the chapter 7, which presents a discussion on the monetary policy, interest rates, money and credit in the economy. The central bank continued the relaxed monetary policy stance that was instigated to support the COVID hit economy during the first half of 2021 as well. The central bank continued to provide financial support to the government by way of purchasing a significant amount of treasury bills to meet the emergency financing needs of the government. However, the monetary conditions were needed to be tightened from August 2021 as signs of imbalances in the economy emerged, particularly the buildup of demand pressures and the pressures in the external sector and financial markets. With inflation continuing to accelerate beyond desired levels amidst sustained pressures in the external sector, further monetary policy tightening was needed. Accordingly, policy interest rates have been raised by 9 percentage points and the SRR by 2 percentage points from August 2021 thus far in 2022. Although the tight monetary conditions are expected to suppress demand pressures in the economy, fiscal policy support is imperative to implement effective aggregate demand management policies while also addressing issues stemming from the forex shortages and supply side factors. With regard to the inflation developments, we saw the inflation accelerating in 2021, driven mainly by global and domestic supply side disturbances, the surge in global commodity prices, upward revisions to administered prices, while also reflecting gradually firmed up aggregate demand pressures. Following an era of 12 consecutive years of single-digit inflation, the year-on-year headline inflation based on the CCPI accelerated to 12.1% by end 2021 and to 29.8% in April 2022. The lagged effect of substantial monetary financing and relaxed monetary conditions are also visible from the large hike in core inflation. Meanwhile, inflation expectations as measured by the Inflation Expectation Survey of the Central Bank remain elevated during 2021, induced by the movements in actual inflation. With regard to money market interest rates, they are increasing in response to tight monetary and liquidity conditions. Yields on government securities have increased substantially since relaxing of the maximum yield rates of acceptance during primary auctions. This increase reflects the effects of both the policy rate increase as well as the market perceptions on large financing requirements of the government. The average weighted prime lending rate has also adjusted along with the monetary policy changes to record at substantially high levels at present. Meanwhile, other market interest rates on deposit and lending products are yet to reflect the full pass-through of the monetary policy tightening measures introduced thus far. So with regard to the credit sector developments, the private sector credit expanded notably during 2021, reflecting improved economic activity buttressed by the low interest rate environment, while lending to the government from the domestic banking system also contributed to the large increase of domestic credit. Credit extended to the private sector by licensed commercial banks increased by over 800 billion rupees during 2021. Meanwhile, net credit to the government from the central bank increased by more than 1 trillion rupees for the second consecutive year. The credit obtained by these SOBs, or state-owned business enterprises, from the banking system also continued to expand in 2021, reflecting their weak financial positions and legacy issues. Despite the tight monetary conditions, the credit aggregates during the 2022 may reflect increases when compared to the previous year due to the effect of revaluation of foreign currency denominated loans and advances. So in spite of the continued expansion of domestic credit, the growth of broad money, M2B, moderated towards the latter part of 2021 due to the contraction in net foreign assets of the banking system. The level of net foreign assets of the banking system continued to deteriorate throughout the year, reaching a negative level of rupees 982 billion by end of 2021, which was primarily contributed by the reduction of net foreign assets of the central bank. As a result, the growth of broad money supply moderated to 13.2% by end of 2021, compared to the growth of 23.4% by end of 2020. Reflecting the increase in currency in circulation and the impact of the increase in the SRR, the monetary base of the economy, that is reserve money, grew by 35.4% during the year. So with that, let me move on to Chapter 8 of the annual report, which contains a discussion on financial sector performance and aspects relating to financial system stability. Amidst strong macroeconomic headwinds, the stability of the financial system was preserved during 2021. The profitability of the banking sector improved considerably during last year compared to the previous year due to notable increases in both net interest income and non-interest income. The asset base of the banking sector expanded mainly due to the growth in the loans and advances and investment. The gross NPL ratio declined, contributed by comparatively higher increase in loans and advances during the year. Meanwhile, the domestic foreign exchange market liquidity was severely affected due to the sluggish recovery of the tourism sector, subdued levels of workers' remittances, low conversion of export proceeds, while large outflows on account of import expenditure and curtailing credit lines amidst unfavorable sovereign ratings. So the performance of the licensed finance companies and specialized leasing companies sector recorded a considerable improvement in terms of credit growth and profitability on an overall basis. Profitability of LFCs and SLCs increased owing to the decline in interest expenses and the increase in non-interest income. Although the gross non-performing loans ratio declined compared to the previous year, the NPL ratio of the sector remained relatively high. Overall, the sector remained stable with capital and liquidity maintained at healthy levels above the minimum regulatory requirements. So that basically ends the discussion with regard to developments across sectors of the economy. Let me now turn briefly on to the issues and policies that were discussed in Chapter 1 of the annual report. As you know, at the time of Sri Lanka gaining independence, the economy was well poised for a rapid economic growth and development. But it appeared to be one of the Asia's most promising nations at that time. However, the country's long-term economic progress has been significantly below its potential, thereby delaying the path towards prosperity. Persistent structural impediments have hindered the progress of the economy. They need to be addressed with a sense of urgency to ensure sustained macroeconomic stability and inclusive growth in the period ahead. As in previous years, this section of the annual report of the Central Bank, which is the concluding section of Chapter 1, discusses several important issues of the economy and related policies. First, we highlight that achieving a sustainable external current account balance is needed. And for that, we need to enhance net inflows from exports of goods and services, as well as through promoting workers' remittances as priorities to overcome the vulnerabilities in the external sector. Next, in financing such external current account deficit, our efforts must focus on attracting non-debt creating inflows. Strengthening the external sector resilience has become the pressing need in the period ahead. Once the external sector debt restructuring is done, the country needs to plan ahead how best to regain the external sector balance and sustain it over the medium to long term. We also highlight the potential role that the Colombo Port City project can offer in improving the external sector balance in the country in the period ahead, particularly by promoting FDI flows in size as well as in timely manner. We also highlight that many macroeconomic issues that are faced by the economy today relate to the suboptimal fiscal outcomes. So we highlight many areas where improvements are urgently needed in order to address the root causes to many structural weaknesses that the country is grappling with for many decades. These include urgent measures to revive the dismal performance with regard to the government revenue, which has fallen to one of the lowest levels in the world. The need to have well-coordinated and evidence-based policymaking in achieving the medium-term fiscal targets, a credible plan to restore public debt sustainability, which has become a major hurdle to unlock access to finance at present. Also improving efficiency of public sector service delivery in terms of quality and efficiency in the post-pandemic recovery phase of the economy is another key requirement for the economy to sustain its performance in the period ahead. Another major issue that needs to be tackled head-on is the over-reliance of the public sector on the domestic banking system. As I presented already, government relied mainly on the central bank to finance the budget deficit in the last year. Further, exposure of state-owned enterprises to the banking system remains excessive at the moment. If these conditions persist, there will be significant setback in the economy as the private sector contribution in the post-pandemic recovery would be severely affected. We are seeing large food inflation at present, while the global price movements as well as the depreciation effects may have contributed to large food inflation, which is observed at present. The lack of well thought through supply side policies by the government also plays a major role in volatile food prices in the country. This affects the efforts of the central bank in maintaining inflation at desired level and destabilize inflation expectations of the public. We are in the midst of a severe energy crisis today. There's a pressing need for all stakeholders of the energy sector to work together to devise a holistic plan for the energy sector that will guarantee energy security of the economy in the period ahead. We should also ensure that the energy-related SOBs serve as growth drivers of the economy rather than becoming a burden to the government. We highlight that export industries need to build capacity and resilience to withstand risks from global issues and commodity price shifts while forming the strategies to grow and diversify in the period ahead. Another area that we highlight is the need to adopt stronger industrial policies and strategies, particularly in the face of the greater need to ensure availability of essential goods in the country, develop import substitution industries, and increase export earnings. Such need is felt so badly today than ever before, as we wait for donations to fulfill our requirement of essential goods, including food and medicine. We need to be more competitive in international trade rather than relying heavily on free preferential trade agreements. High quality and low cost of production do not come without a good deal of research and development. We need to improve domestic higher education opportunities and standards in the country. There is an increasing number of departures for higher education, causing a significant foreign exchange outflow on the one hand, and non-trivial brain drain on the other. So with right policies, we can not only retain our talent within the country, but also we can attract foreign students into the country. So another long-standing issue that we have in the country is that we continue to grapple with creating a sustainable agriculture sector that's capable of generating healthy income levels to sectoral workers while ensuring food security and efficient ecosystem management that will enhance the overall productivity of the agriculture sector. We also highlight the issues faced by the micro, small and medium scale enterprises, MSME sector in Sri Lanka, despite being a key driver of economic growth and having more potential for further growth in the post-pandemic and post-crisis recovery. Policy priorities at the national level are needed to address the issues faced by the MSME sector. We also reiterate the issue that Sri Lanka continues to struggle with waste management issues that have been further amplified by the COVID pandemic. There have been several policy initiatives on this in the past, but they remain by and large inadequate. On a related issue, we highlight the need to focus more on green development as a critical contemporary need to ensure that Sri Lanka's natural resources are better conserved and also restored so that the economy can reap up to the full potential of its ecosystem. Despite the country's efforts to achieve its target of alleviating all forms of malnutrition by 2030, developments pertaining to COVID-19 and other supply-side shocks observed recently in relation to agricultural commodities could severely threaten the outcomes achieved thus far while posing hindrances to long-term development of the economy. So last but not least, a more pertinent issue in Sri Lanka's labor market is the stagnant level of female labor force participation observed for the past 3 decades. This highlights that a significant portion of the labor force remains outside the ambit of the economy and the development process, warranting urgent attention as the economy tries to rapidly recover from the effects of the COVID-19 pandemic and to progress into higher growth trajectory over the medium to long term. So all in all, we believe that committed efforts of the government and all stakeholders in define the looming dire economic consequences and keeping the economy floating with a sense of urgency while addressing the structural issues remain to be the immediate priority to revive the economic outlook and preserve the macroeconomic stability going forward. So after this the issues section, I need to highlight one area where we have included in all chapters some special articles called box articles. So there are 12 box articles in this year's, last year's annual report. And they are the importance of the International Monetary Fund programs. So we are now at the moment currently engaging with the IMF on technical level discussions. So we highlight the importance of IMF programs by looking at the all forms of programs that IMF offers to countries and what kind of support that we can obtain to come out from the current crisis that the economy is facing. And the other box articles are the achieving Sri Lanka's external sector stability in the medium to long term, which is also by a need at the moment as Sri Lanka is going through a severe balance of payment crisis at the moment. We also highlight in another box article on fiscal consolidation and the path to macro fiscal stability. Again, this is also very timely because most of the issues that we are currently facing have some relation to or connection to the dismal performance in the fiscal sector. So we need to highlight the how we can basically ensure macro fiscal stability going forward by ensuring fiscal consolidation. And another box article on capitalizing micro, small, and medium-sized enterprises as the growth driver and the challenges that the sector is facing, because in Sri Lanka, MSME sector plays a major role in the overall economic space. So we need to basically address the challenges that the sector is facing to support to growth over the medium term. And another box article on the role of tourism sector during the post-pandemic recovery in Sri Lanka, because this has been a strong sector supporting foreign exchange inflows to the country, as well as the employment generation over the past several decades. But because of the pandemic, and prior to that, these Easter bombings, and now because of these energy sector issues and other social unrest that we see on the street, the tourism sector has been affected to a great extent. So we need to revive the industry fairly quickly in order to capitalize on the potential that Sri Lanka has in terms of developing the industry going forward. And another box article on the impact of informal money transfers on financial markets and the economy. This is also an issue that we tackle almost on an everyday basis, because currently the banking system is having significant shortage of forex liquidity. And so this informal activity or the gray market activity has greater bearing on that issue. So we need to basically see how we can contain the gray market activity so that the forex liquidity can be absorbed back into the banking system to support the imports of at least essential goods and goods that we need at the moment. Also, another box article on re-strategizing the state-owned enterprises as growth facilitators. Again, this is another area that's been the performance of this area has been dismal in the recent decades, which has burdened the fiscal operation to a great extent, as well as it has created some pressures into the banking sector as well, due to their high exposure to the domestic banking system. And also the lack of cost-reflective pricing mechanism of major utility services also remains a major issue in terms of strengthening their balance sheet going forward. Another box article is a review on recent global inflation episodes. Again, we are seeing unprecedented levels of inflation caused by domestic factors as well as global factors. So we are basically reviewing the global inflation episodes to make some connection to what we see in Sri Lanka and how that is being looked at in the overall context globally. And another box article on COVID-19 concessions and moratoria, challenges and way forward. We know we have been providing a lot of concessions to the businesses, SME sector during the pandemic times. But now we have to make a strategy to come out of these concessions to while also allowing recovery of this MSME and other sectors, also by giving due consideration to the issues that the financial system is facing if these concessions continue for a sustained period. And another box article on national financial inclusion strategy of Sri Lanka, better quality inclusion for better lives. This is another area which has gained a lot of attraction in recent years. We can make sure that the overall the growth is inclusive, and in that the financial sector's role that's needed to ensure that the all these communities are very well sort of connected to the financial system of the country, so that they can make use of the modern technology and other means of improvements that the sector is offering by and large. And then another box article on the fintech innovation, way forward for banking supervisors, followed by sort of our usual box article, which comprises major economic policy measures adopted during the year of concern, maybe the latest developments or measures that have been adopted in the year 2022 thus far. So I would invite the readers, to have a look at these book articles, which are basically timely and covering major areas of importance in the current context. So before I conclude my presentation, I would like to take a couple of minutes to express my sincere gratitude to many parties and individuals within and outside the central bank for their invaluable support given to us to make this present publication a success. First of all, I would like to thank Governor of the Central Bank and the Monetary Board of the Central Bank for continued guidance and encouragement in preparing this report and finalizing it under so many constraints. Also, I'm grateful for the senior management of the Central Bank, Deputy Governors, Assistant Governors, for valuable comments and suggestions in the process of finalizing this report within a relatively shorter time span. I would like to express my sincere thanks to my predecessors in the Economic Research Department, who have started the process of finalizing this annual report before I took up the position as Director of Economic Research. I would like to thank all the heads of department of the Central Bank and their staff, especially the Statistics Department and the Macroprudential Surveillance Department, for unwavering support given in all possible ways and helping us out to get this statutory publication finished on time. Also, I'm indeed grateful for all the government institutions, agencies, regulatory and corporate bodies, banking and non-banking sector institutions, and all other stakeholders, including the printing press, for all means of engagement, including timely data provision and other logistical support, without which this publication wouldn't have been a success. And finally, I would like to turn to a special group of people for whom I am greatly indebted, and that is the staff of the Economic Research Department, who have sacrificed so much to get this task done on time. So even if I want to mention all of them by name, due to a time limitation, I would like to mention only a few. First, my additional directors, Dr. Sujitha Jagajeevan, Dr. Kisiri Alepola, who is also the moderator of this webinar today. And then my deputy directors, Dr. Lasitha Padberia, Dr. Vipula Vikramarachchi, and Dr. Shanika Ratnayaka. Further, the division heads of the Economic Research Department, who have been working day and night all through these years when it comes to annual report work, as well as any other work for that matter. A special gratitude is owed to all families of the staff members, including mine, for bearing with us under extremely difficult circumstances. Last but not least, I want to express my special gratitude to Dr. Kasun Patirege and Mr. Navin Perera and the team who were kind enough to take the painstaking job of compiling this presentation with a great deal of patience and commitment. So with that, I want to thank you all again for joining this webinar. And also, I would like to apologize for not being able to mention everybody by name individually due to the time limitation. So with that, I end my presentation and hand over the floor to the moderator. Dr. Halapal, thank you.
Thank you very much, Dr. Harishchandra, Director of Economic Research, for giving us a very comprehensive presentation of the status of the Sri Lankan economy, challenges, and outlook. With that, I am happy to open up the discussion towards the questions. Once again, I would like to request the viewers to post your questions on the Q&A options in the Zoom or through Facebook page of the Central Bank. Also, kindly note that the duration of the Q&A session would be limited to about 30 minutes, and accordingly, we might not be able to answer all the questions. As such, you may forward your questions to the Communications Department of the Central Bank if your query is not answered during the session, please. We have already received several questions. Let me take the first one. The question is related to the stability of the banking sector with respect to the recent developments in the economy. Accordingly, the viewer says, recently the dollar shortage of the country worsened and interest rates in the banking system soared. The question is, are there any significant threats to the stability of the banking system at present? I suppose the Deputy Governor, Mrs. Fernando, could respond to this query, please.
Yes. Now, if we take the banking sector, as was also said by Dr. Harishchandra, it has been quite resilient, like having adequate capital and liquidity levels. But of course, quite late, especially because of the forex difficulties that they were encountering, they have faced some difficulties to meet their obligations and also the kind of borrowings and all that. And there have been certain drying up of credit lines. So this, I think, with certain recent measures that have been taken, especially with regard to the flexibility in the foreign exchange rate, and also the liquidity improving with we are getting more export proceeds than remittances following the changes in the exchange rate policy. I think there will be improvements. And on the other side, the two state banks have been getting involved in facilitating the essentials imports. So therefore, there again, they have not been at times been able to meet their dues on a timely basis. So these have brought a little bit of stress in the banking sector since there have been interbank borrowings and also commitments from the state banks to the private banks. But I see the several measures taken now and also certain measures to control on the imports expenditure. This situation is improving, and banks are currently prioritizing their payments, foreign currency payments, and trying to meet these. So over a few weeks, and a few months, this situation should improve. Then on the interest rate, also on a mark-to-mark basis, there are impacts on the bank's kind of balance sheets. Of course, majority of it is unrealized valuations. So we have also, as a regulator, looked into these situations, and we are trying to allow some policy support by way of certain prudential relaxations, because as I said, the buffers that have been built over the past few years, they will become very helpful at this moment, and we are in a position to kind of allow the banks to make use of those buffers. And again, on the expenditure side, we have already kind of informed banks not to pay their dividends unless their accounts are being audited, and also to be extra cautious on their discretionary payments and have exercise certain controls. Then when it comes to the capital adequacy and liquidity management, there is kind of more close supervision and more frequent kind of interaction with the banks and the boards of directors of these banks. So through those, we are of the view that we could manage this situation, especially when it comes to rupee liquidity. We don't see a kind of a difficulty, because even statutorily, central bank has an obligation to safeguard the interests of the banks and maintain the financial system stability. And there are some instruments already available. Even at the recent press conferences, Governor also has informed the general public that such instruments are available and measures will be taken. So in that sense, in my view, there are difficulties. There is a bit of a stress situation, especially with regard to the foreign currency position. But with measures taken, and also through kind of very close supervision and engagement of the boards of directors of banks, I think we can manage this situation.
Thank you very much, madam, for your detailed answer. I really appreciate it. The next question, actually, there are a couple of questions on GDP growth, rebasing of GDP, etc. So the viewer says annual report indicated that this year's GDP growth would be estimated around 1%. How do you see the plausibility of this estimate now, given the challenges of the economy is facing at present? So that's the first question. There's another related question. As we learned, the Department of Census and Statistics is planning to rebase GDP as it was done in 2015. What changes can we expect from this exercise? So these two questions, could Assistant Governor Mr. Rohan Vijayasekara respond to this, please?
Thank you for the question, Kitsari. I think I don't have to discuss about, this is a very important question, and we are not going to discuss about 2021 GDP growth, because Dr. Harish has already discussed about it during his presentation. Even though the near-term GDP growth for 2022 is 1%, but it's going to be a very challenging. Almost all indicators have downward, and I'll tell you few reasons for that. Actually, the fertilizer issue continued to Q1, and of course, end of the quarter, we saw a sharp depreciation of the currency, and with that, due to the dollar dearth in the market, we encountered fuel issues. As a result, we are facing the power cuts. So if I touch upon agriculture, even agriculture activities are affected by fuel shortages, because they cannot operate their tractors, plus other, let's say, industry. When it comes to industry, manufacturing sector is severely affected due to power cuts. Even with power cuts, if they have fuel, they would still survive with their production to some extent. But unfortunately, fuel issue is also there. So they are suffering, and it's a great challenge for them to uh, come to reach their production levels. And the other one is construction sector. Construction sector is around 8% of GDP, and mining and quarries, which is closely related to construction, is about 2%. Altogether, is about 10%. Due to the exchange rate depreciation, cement prices have increased, and other raw materials, intermediate goods for construction also have increased. So cement construction sector has greatly affected under the industry sector. So the third one, the service sector, even though we have been seeing improvement in value addition of financial sector, we are seeing a greatly impacted area, that is tourism, which even though we expected improvement in tourism sector, because of the power cuts, because of the conditions which appeared in the recent past, have given us negatives for tourism sector as well. So all in all, I think almost all indicators are downward. So, but one plus is recently, about a week ago, I think, Prime Minister announced that the government is going to give urea or fertilizer for 10,000 rupees. I think it will have an upward impact for agriculture. Again, lastly, if I come back to tea sector in agriculture, usually tea production is around 300 metric ton, but it has reduced to 200 for around 200 mark, so 200 levels. So I think export sector is also will be affected due to that. Second question is GDP rebasing. Yes, Department of Census and Statistics is planning, not only planning, they have already completed their homework, groundwork in rebasing exercise. As you know, National Accounts framework gives us a value of the economy, which covers production, industry, production, income, and expenditure. GDP is one of the main indicators of national accounting estimate process. So GDP, reflection of GDP in real sense needs updation, continuous updation. So continuous updation is called the rebasing exercise. So basically, broadly, there are three areas to be considered under this under reasons for rebasing. One is production, prices of production, production structures, and consumption patterns, change all the changes of these areas. Secondly, economic change of economic activities due to innovations, and lastly, as the third one, not adequate coverage of economic activities. So I think census and statistics have considered all these three into their rebasing exercise. In considering three main areas, one is expanding the production boundaries. Number two is improving source data, and introducing methodological changes. Of course, expanding production area is a good example is Port City. So because of that activity from 14 to 18, there are improvement in value addition, but of course that is one time. So but due to that huge increase of value addition due to the area, I think that there would be many fluctuations, major fluctuation due to that, but in time to come, it will ease off. And number two is new economic activities, that is mainly the information technology. And if I touch on source data, one of the important surveys they did in the area of IT, business process management. So because they didn't have a survey, and another thing they considered already the economic survey done in 12-13. So I think there are more adequate estimations. If I tell you one, a methodological improvement, in construction, raw material ratios have changed in recently. So they have also taken care of that change, and so all in all, they have already I think completed and few more work to be done. So soon they will introduce this release the rebasing GDP. Of course, there'll be a new series for rebasing from 2015 onwards, because 2015 is the base year. So from 15 to 20 or 21, I'm not too sure, we'll have a new set of estimates. But finally, I would say that having rebased estimates will give us improved results. Improved results will give us more evidence-based, improved evidence-based results using GDP. Also, almost all the ratios which depends on GDP are very important for our debt restructuring and present work involved in IMF discussions. Thank you, Kitsari. Over to you.
Thank you very much, Assistant Governor, Mr. Vijayasekara, for your clear and detailed explanation. The third question, this is on the exchange rate management. So the viewer says the central bank currently indicated that more flexibility would be allowed in the determination of the exchange rate. At the same time, the central bank started informing the banks a narrow variation margin of the exchange rate on a daily basis. So the question is, please explain the background of this recent measure in managing the exchange rate. So probably Assistant Governor Mr. Jayalat could respond to this, please.
Thank you, Dr. Alepola. I think, yes, central bank has changed its methodology in communicating exchange rate and managing exchange rate. Of course, I think the gentleman who questioned it and everyone else might have noticed that once we release the exchange rate or prevent determining or stop determining the exchange rate that 200, 203 levels, what has happened was that the exchange rate depreciate significantly. This depreciation was instantaneous, and thereafter the volatility or movement in the exchange rate day to day was very high. And this has made the lives of everyone very difficult because the people and the public was not able to determine where would be the exchange rate at the next day or next point in time. So as a result, we had wider discussions, the wider stakeholders of the central bank and particularly the banking community. And we analyzed the information available, and we found that it's the foreign currency holders driven market rather than the buyers and sellers both, because there were many buyers, but sellers were limited, and sellers wanted higher rates. And we saw that they were shopping around and asking for higher and higher rates. And this has resulted in consecutive depreciations, which are not beneficial to everyone and which are not reflecting macro fundamentals that we have seen witnessing in the economy. So as a result, we decided to provide some guidance to the banking community so that banking community will set the tone for the public in the transacting their foreign currency transactions. In this way, we have started this mechanism as communicating a weighted average of the previous day's transactions as guidance. In addition, or on top of that, we have introduced plus or minus range within which the banking community can transact, particularly among them. Of course, at the same time, we have informed the banks to have a reasonable margins above and below the bank transacted rates for the customer transactions. Not only that, we have introduced a cap on the fees that banks could charge on the customer transactions. You know that banks, when they're transacting with you, they are involved with different electronic communication with bank, transferring money from one place to another, things like those. So that involves costs. So we want to make sure that they won't charge excessive costs, and they have to be limited within the specified manner. So with these kind of parameters, we have issued guidance to the market and continue to issue. It's under the Monroe Act that central bank, the governor of the central bank determines the range on daily basis. And with this, we have seen significant stabilization in the exchange rate. Of course, you may have seen the exchange rate, particularly the gray market exchange rate and the formal market, the banking sector exchange rate, has very wide spreads or differences prior to introduction of this mechanism. So little by little, we have seen that entire community, the banking community and even the informal market falling in line with this, and even transaction spreads of informal market compared to the banking sector was narrowed. I wouldn't say that they were at the ideal level yet, and I wouldn't say that the exchange rate still reflect appropriate macroeconomic conditions, but still it's moving in the right direction. So we can expect that going forward, spreads narrow, and rate itself is seeing some appreciation. Our expectation is, together with the latest measures that we introduce, of course, you have seen significant jump in interest rates, significant restrictions or restraints on the import on non-essentials, as well as use of open accounts and things like those. With these kind of measures, we expect that we can concentrate whatever the available funds to the needy areas, what we see essentials. We all know that fuel, gas, food items, medicine, these are essential during this time. Of course, we may not like to have these in normal circumstances, but these are extraordinary times. We need extraordinary measures during these kind of times. So with that, central bank introduced this. We are witnessing little by little the banking community and trading public also falling in line with this. And that's a very pleasant or encouraging development. We hope that this would continue, and we can expect normalization in these rates and volatility in time to come. Of course, the range that we introduce is between 2 rupees and 60 cents plus or minus. The first few days, subsequently it was narrowed to 2.5. And today you might have witnessed that it has expanded to 3 rupees on either side. So this indicates that the community is behaving well, and what we expect is particularly those who have foreign exchange, now you don't need to wait and further depreciation of currency or further deterioration of the situation, things like those. I think current measures would encourage you to come back and reap the benefit of these rates which are appropriate given the circumstances. And at the same time, the compensation for your rupee is very high at the moment. So you can now reap the benefit of high compensation for rupee assets, even after you convert this foreign currency. So with that, I would stop here. Thank you very much.
Thank you very much, Assistant Governor Mr. Jayalath, for your comprehensive and useful explanation. Now, the next question is with regard to the conduct of the monetary policy. So the question is basically why Central Bank of Sri Lanka has been printing large amount of money. There's another part of the question. What are the implications of it, and why can't you stop it now if it is harmful? Probably Director of Economic Research, Dr. Harishchandra, could respond to this, please.
Thank you. Thank you, Dr. Alapola, for that question. I think this is a question which is repeated in many fora. And we have also provided answers in our press conferences, subsequent to the monetary policy decisions. So the concept of money printing is something which you can define in many ways. Now, one common aspect is that to relate that to the sort of increase of the treasury bill holding of the central bank. And also there are some other aspects to look into that in terms of the indicators of monetary conditions, which may include the currency in circulation, whether it has gone up or down, what happens to the broad money growth, whether it has increased substantially, what happens to the reserve money growth, whether it has increased substantially. And there are other measures that you can also take into consideration when talking of this monetary easing. So, but in this case, which warrants a special sort of emphasis, of course, because as we saw from the onset of the pandemic, the economic activity moderated, and we had a contraction, and in 2020, and obviously with the contraction, the government revenue would definitely fall. And on top of that, as you remember, back in late 2019, there was a significant reduction of taxation. The government wanted to sort of give more impetus for the private sector to grow with lower tax regime. But pandemic came in March 2020, and the regime didn't change. So there was significant loss of government revenue on top of the already contracting activity, which made a huge dent in the overall sort of government revenue performance. Then the government got into the trouble of how it can meet the essential expenditure requirements, like payment of salaries and wages, payment of expenditure in the health sector, and the other goods and services that are needed to run the sort of the economic activity, like education sector, public administration sector. And on top of that, there's the interest or the debt servicing payments, which became due. So there's a huge gap between the revenue and the expenditure requirement, which has to be supported by some sort of means. And what countries did in general globally was that the central banks stepped in such circumstances and provide some cushion to the government to meet the essential sort of payment requirements. So the Central Bank of Sri Lanka was no exception to that. So we also wanted to provide some cushion to the government to meet its urgent expenditure requirements. So one way of doing that is to buy treasury bills from the primary market. So as was done by many central banks in the world. So we had to do that under exceptional circumstances. So our stock of holding of government securities shot up by significant margin. And that was the reason why the current stock of holding also remains significantly high, despite the pandemic is seemingly over. But unwinding or unbundling or offloading that huge stock of government securities is not an easy task. You can't do overnight. Because on one hand, the revenue remains still low, and the government is already in the process of revising the tax policies, which will take a while to make some impact on the government coffers. So that has to be a gradual process. You can't just offload the over 1 trillion rupees worth of government stock of government treasury bill holding for the central bank. It has to be a gradual process. Otherwise, it will lead to some other issues. For instance, so if we are doing that now, so the liquidity has to be coming back to the central bank, and we know our liquidity conditions are all already at very large deficit levels. So you can't just absorb over 1 trillion rupees from the market now. So therefore, it has to be a gradual process. And of course, the outcome of that would be inflationary, because large and excessive provision of money to the government by way of buying treasury bills from the primary market is adding a lot of money to the system, and that money remains there in the system unless it comes back to the central bank. So with that, there will be a lot of pressures on the general price level, and which will be inflationary for sure. We have seen some impact already in our inflation development, but central bank and the government remain committed to reduce the stock of holding of the government securities of the central bank. And so we are doing that in a sort of a gradual manner, rather than creating further issues in that process. So, so that's pretty much the sort of background to that question. And I would have for now, Dr. Alapola.
Thank you very much, Dr. Harishchandra, Director of Economics Research, for your detailed answer. So I think we can have only one more question, given the time constraint. So there are actually several questions on debt services and debt restructuring. So I'll select one of them, which have two parts. So the question is, what exactly do you mean by debt restructuring? And what is the progress of the debt restructuring process in Sri Lanka thus far? Could anyone in the panel respond to this query, please?
Okay, I'll try and answer, but the panel members also will chip in. So what government did on the 12th of April this year is to announce a debt standstill, which is to say that government is sort of suspending the foreign debt servicing payments to selected lenders, which include the commercial lenders to Sri Lanka and bilateral lenders. The commercial lenders include mainly include the holders of international sovereign bonds issued by the government of Sri Lanka. Bilateral lenders mainly include these, our countries that have partnered with us in the past to lend for projects and all other purposes. And we have excluded the restructuring or domestic debt by and large because our main focus was on suspending the foreign debt, foreign currency denominated external debt. So with regard to the process, soon after the announcement of that debt standstill, as an interim measure, not to mean that we are not paying anything, but as an interim measure until a debt restructuring plan is worked out. So what's the debt restructuring plan? That is to basically agree with the creditors of a plausible plan for us to find some forex over the medium term and then make the payments in an agreed extended time period with some concessions on the overall capital repayment or with some concession on the sort of applicable interest rates. So the process has begun since then, and the government has asked for requests for proposals for two types of advisors, which include legal advisors and financial advisors. And the selection process is almost complete, and the approval of the Cabinet of Ministers is due shortly in terms of the legal advisors and the financial advisors, who will take a stock of our debt stock and then work out debt sustainability analysis. And based on that, of course, the IMF also is on board in that whole process. So we will see what kind of reduction in the overall capital repayment requirement is needed to make our this path more sustainable over the medium term. And then we have to negotiate with our creditors in terms of so-called possible haircut, how much you can shave off of the outstanding debt liability and make it sort of extended period of repayment so that our total outflows would be less in the medium term in terms of foreign exchange requirement, because we are seeing sort of restricted access to capital market now. So we can't go and mobilize Forex from the market. So we have limited inflows of Forex. So that we have to find out a way that how we can match the inflows with the outflows in a sustainable manner. So that process will take a while. So once these arrangements are agreed upon, then the government of Sri Lanka will start repaying the debt to the creditors. So the process-wise, once the advisors are appointed, they'll soon start working with assessing the debt servicing requirements, and also we'll start negotiating with the creditors for an agreeable position from both sides, creditors as well as the government of Sri Lanka's repayment capacity. So usually it takes a while, from 6 months to some period. So depending on the time it's taken for an agreement, bilaterally or mutually, and upon agreement of that, and by the time we are now in the discussion with the IMF on technical basis, and that process also continues. So by that time, some level of agreement with the IMF also would be possible. So then the whole thing will come into place in the coming months, so that we can start making the sustainable path for the country over the medium term. And that's the position, Dr. Alapala, with regard to this debt restructuring negotiations.
Thank you so much, Dr. Harishchandra, for your precise answer, which is very useful in understanding the current status of the debt restructuring process in Sri Lanka. So that brings us to the end of the webinar today. So I am mostly grateful to the Governor of the Central Bank of Sri Lanka, Dr. Nandalal Weerasinghe, for his excellent guidance for all of our endeavors, including today's presentation. I would like to thank the Deputy Governor, Assistant Governors, Director of Economic Research, and the Additional Director of Economic Research for enlightening us on the state of the economy, immensely contributing and assisting to this timely and informative webinar. Let me also thank all of our viewers joining the webinar and posting questions, thus adding more value to the session, making it more interactive and resourceful. Last but not least, a big thank goes to the director and staff of the Center for Banking Studies for providing logistics for the webinar that facilitated smooth operation without any interruption. Before winding up, I would like to bring your attention to the fact that Central Bank is conducting this seminar in Sinhala medium on 25th of this month and in Tamil medium in 26th. Accordingly, we appreciate if you could pass this message to your colleagues as appropriate, please. With that, we conclude this seminar today, and goodbye to all of you. Have a pleasant evening. Thank you very much.